Welcome to this Affirm training session. KPMG is proud to be an Affirm corporate sponsor. We are most pleased to support this important training as Affirm works to help government in its movement to greater strategic application of ERM concepts. For all those in government attending this session, thank you so much for your service to our country. You make an important difference each and every day. Today, governments at all levels face ever tougher budget choices and even more challenging long-term fiscal sustainability challenges. They are faced with doing more with less while meeting vital public needs and protecting our nation's security. While certainly not a panacea to what will be difficult spending choices, ERM can help focus appropriate attention on programs and operations of greatest risk, including preparing for and avoiding or mitigating emerging risks. I'm Jeff Steinhoff, a Managing Director in KPMG's Government Practice and Executive Director of the KPMG Government Institute. The Institute was established to serve as a strategic resource for government at all levels, and also for higher education and non-profit entities seeking to achieve high standards of accountability, transparency, and performance. Before joining KPMG over 7 years ago, it was my privilege to serve as Assistant Comptroller General of the United States for Accounting and Information Management and Managing Director for Financial Management and Assurance at the U.S. Government Accountability Office during a 40-year federal career. I led GAO's largest audit unit and had responsibility for developing the standards for internal control in the federal government, the GAO Greene Book, which incorporate the COSO internal control framework on which ERM is premised. Joining me today is Edmund Greene, who will now share with you his background. Edmund?
Thank you, Jeff. And thank you all for making time to learn more about what is becoming a vitally important topic in both the private sector and in government. I would also like to echo Jeff's sentiments in support of our men and women in the armed forces and the civil servants who serve our nation each and every day. Just briefly about my background, I'm a managing director in the financial risk management practice of KPMG, where I assist clients in both government and the private sector with the implementation of ERM programs. Prior to joining KPMG nearly 10 years ago, I held various positions, mostly in financial services, including leadership roles in corporate treasury, commercial lending, and internal audit. I'm currently leading engagements at the FDIC, as well as ERM governance, risk, and compliance engagements at banks and insurance companies. Jeff?
In the earlier foundational training, you learned about the concepts that provide the framework for ERM and the execution of those concepts, such as risk identification and assessment. This session will focus on 3 challenges routinely faced in implementing effective and efficient ERM programs. At the end of this training session, you should be able to consider strategies to 1, identify and respond to emerging risks that require immediate action, given the risk of serious impacts on government performance or on the well-being of the public or security of the nation, both short and long term. Second, understand and address long-tail risk that may have many elements and stakeholders and may be deeply rooted and long-standing, may go far beyond one organization's span of control and may expand or emerge over time as change takes place. And finally, gauge the effectiveness of risk mitigation so that actions address root causes and add value. We'll talk a lot today about adding value. That's what this is all about. ERM is not another process or the new management action of the day. It's something that's really focusing on adding value. Now let's first review a few basic concepts discussed in the earlier foundational training to provide context for the three issues being addressed in this session. We have translated COSO's four underlying ERM framework principles, which are in italics, to government. First, every entity exists to provide stakeholder value. Applied to government, the degree to which needed public services are provided and missions are accomplished in a manner that is both effective and efficient. Second, all entities face uncertainty, and the challenge for management is to determine how much uncertainty to accept as it strives to deliver stakeholder value. Applied to government, making trade-offs in establishing the level of acceptable risk to assume in the public interest and in wisely spending taxpayer dollars. Third, uncertainty presents both risk and opportunity, with the potential to erode or enhance value. Applied to government, enterprise risk management enables management to more effectively deal with uncertainty and associated risk, as well as the opportunity to enhance the capacity to build value. So you've got to look at it both ways. By collectively considering the full range of risks across the enterprise, government is better positioned to, first, prioritize risks that may jeopardize mission effectiveness and efficiency. Consider options, putting everything on the table without regard to stovepipes and the status quo. Third, take actions that address root causes of risks that transcend individual interests in favor of government-wide solutions. Again, break down stovepipes as needed to build value. Fourth, manage expectations, reduce surprises and/or variability of outcomes. Fifth, take advantage of opportunities to improve mission and service delivery, again, adding value. Sixth, identify and eliminate redundant or ineffective controls. One of my theses is that perhaps we have too many controls, but not always the right ones. Next, rationalize cost by viewing risk more broadly and formulating strategic responses to target identified risks. And finally, assessing cost benefits of possible actions in the context of the enterprise mission as a whole. The fourth COSO issue, value is maximized when management sets strategy and objectives to strike an optimal balance between growth and return goals, as well as related risks, and efficiently and effectively deploys resources in pursuit of the entity's objectives. Viewing risk from an enterprise perspective, governments align risk appetite and strategy. In considering emerging and long-tailed risk and mitigation effectiveness, government will need to anchor its efforts in line with its risk appetite, which will be covered in greater detail in another module of this training. In a nutshell, defining the risk appetite, first, reflects the agency's mission and strategy, including organizational objectives, strategic plans, and stakeholder expectations. It should be noted that risk appetite should be established by the organization's top leadership in conjunction with stakeholders, such as the Congress, and in sync with the President's priorities. Risk appetite acknowledges a willingness and capacity to take on some level of risk and a tolerance for loss or reasonably quantifiable negative outcomes. Risk appetite incorporates a governance and reporting framework that helps ensure day-to-day decisions are made in line with the organization's risk appetite. It also includes quantitative and qualitative performance measures and addresses the skills and resources and technology required to manage and monitor risk exposures in the context of the risk appetite. Also, it is periodically reviewed and reconsidered to address emerging issues and evolving expectations of government. We also ensure that there is accountability and transparency for results. Management has established what its appetite is. People are empowered to work within the framework, but if they go beyond or perhaps don't go to that threshold really, are they in fact held accountable for those results? In my 40 years as a federal auditor, many times management would come back in responding to an auditor's recommendation, oftentimes centered around establishing additional internal control, and say, you know, we don't think those controls are really needed or cost effective. We decided not to do X, Y, or Z. When you ask them then, okay, show us where you made this determination, where you actually assessed risk, where you actually made a choice not to do something because you didn't think it was cost effective to actually control that area. No one ever came back ever to me and showed that they had actually assessed and considered those risks. No one ever said, we have established an appetite for risk, we're willing to accept this level, and therefore it falls within those parameters. It's all right with us. So what ERM really does is it provides that focus. It really provides a mechanism for management to look at risks and to assess how far it's worth going and to make sure they're going after the right things. We all take risks in our everyday personal and professional lives. Establishing the risk appetite may start with asking fundamental questions, such as, what amount of risk are we prepared to undertake in the pursuit of the organization's mission? Things as simple as, what do we lose sleep over? What do we not want to see on the news or in blogs? What are the clear expectations of stakeholders? What do we want to make sure happens and happens well? This is one important component of control. Control is not just to stop something from occurring. It is to help facilitate what you want to happen and happen well. What problems have developed or emerged in other organizations that could be a problem in our agency as well? What controls are now in place? Do we know how they're working? Do we know about their cost and benefits? What level of control can we reasonably afford? And how do we get the most bang for the buck? What changes in the agency or externally may have introduced new risks? These are just fundamental issues, but always focusing on the environment you're in, always looking for value, and always trying to break down the stovepipes that oftentimes address risk within a very narrow parameter. Now let's move to our first learning objective, identifying and responding to emerging risks. Edmund, we all too often find that serious problems suddenly appear on the radar screen. Problems that could have reasonably been anticipated and mitigated perhaps. In the aftermath can be finger pointing and calls for reform. You even see officials asked to resign, or sometimes they're fired by, let's say, the president. From your broad experience working with government, quasi-government organizations, and private sector companies to establish and implement ERM programs, how can organizations better identify and respond to emerging risks that require immediate attention given the risk of serious impacts? How does ERM play into this equation? And why do serious problems seem to slip through the cracks all too often? Edmund?
Well, thank you, Jeff. This whole notion of emerging risk is tricky in the sense that, by definition, these are risks that are in the process of becoming. And so the key to understanding emerging risk is recognizing that organizations and the environments that they operate in are never static. And so as a result, ERM and the management process must not be viewed as sort of a one-time event, but rather as an ongoing process requiring the maintenance of constant vigilance, if you will. And so, if I can use a military term, in naval aviation, there's this whole notion of situational awareness, which is maintaining an understanding of where you are with respect to the achievement of your mission. And so in many ways, ERM is about maintaining situational awareness. When viewed in these terms, understanding emerging risks become an essential organizational capability, reflecting an organization's ability to learn and adjust to changes in the internal and external environment. And so, for example, one example of a potential emerging risk in the communicable disease arena is the risk of a change in the transmission mechanism of a disease from, say, direct contact to becoming an airborne transmission. And so the people who are operating in that arena are constantly surveying and constantly checking to see how these agents are changing so that they can formulate appropriate responses. Because obviously a response to an airborne pathogen is very different to a response from a pathogen that might be transmitted through direct contact.
To echo these points, be a student of government and a student of the world. Always be mindful of what's going on around you. There can be a big risk associated with standing pat and not adapting or changing quickly enough to address new and emerging risks. The changes that I have seen in my 47 years in the profession have been mind-boggling. Change brings tremendous opportunity, but it also introduces new and emerging risks. Just look at the many organizations that have experienced major and highly publicized data breaches. They didn't view this as their core mission. They were not adequately prepared for a risk that continued to expand and emerge in different and more powerful forms. They just didn't look at it as their problem or their issue, but it ended up doing a lot of reputational and in some cases business damage to either the government entity or the company. So we have to really focus on thinking outside of the box, going beyond your particular entity, and looking at the world around you. There might be an emerging risk. It doesn't relate per se to your mission, but it can affect you in devastating ways. GAO can be very informative here. While this is GAO's high-risk program, which goes far beyond emerging risks, some of the criteria for considering risks can be helpful in considering emerging risks. GAO has established both qualitative and quantitative risk criteria for its high-risk program. Now let's first look at the overall criteria. The issue is at the center of congressional and executive branch attention. Think of the area of cyber today that might be not at the center of your agency's mission, but it's at the center of what government is concerned about. An area would have high public interest and or large dollar outlays. The risk may figure prominently in agency strategic plans and annual performance plans and reports, or it may have known performance and accountability or high-risk issues. And you've got to think about not only your entity, but entities that you deal with day to day. While many times people view things in a stovepipe manner, you have to look across. So if you've got a trading or a business partner, or you're having, let's say, a state or local government carry out a program on behalf of your agency, you have to be focused on what are the emerging risks that they may face, because they can ultimately affect you. Now, I mentioned that GAO has both qualitative and quantitative factors. Let's look at a few of those qualitative factors, because they really drive down to how one would consider risk and what is the risk to them. Let's take areas like health or safety. Your mission may not necessarily be health or safety, but if because of the way you've carried out the mission, health and safety are jeopardized in some manner, that can represent a high risk to you. Service delivery, national security, national defense, economic growth, privacy or citizens' rights. These are big deals. Does it significantly impair service? Do programs fail? Is effectiveness significantly reduced? Is efficiency significantly reduced? Is there the potential for injury or loss of life? Think of when you have some type of disaster that could have been avoided. Do you have unreliable data for decision making? Does whatever the risk is result in reduced confidence in government? And finally, is there unauthorized disclosure, manipulation, or misuse of sensitive information? such as personal, financial, or programmatic data maintained in computerized systems. As someone who has had my information affected by every high publicized hack in the past several years, including my federal personnel data, I'm sensitive to those issues. And I think most people are sensitive to those matters. But is computer or cybersecurity really a core mission? Well, it represents an emergent and high risk, no matter what your mission is. GAO also has quantitative factors. Some of these might be a little higher because they're looking at government-wide, but they're talking about $1 billion or more, or spending related to a portion of a major program or mission area. They also speak to areas that are not related to finances per se, such as the value of major assets, whether they be loans receivable, equipment being impaired or lost in some manner. They speak to revenue sources, taxes due, not being realized. They speak to major agency assets, inventory or property being lost, stolen, damaged, wasted, or underutilized. It can relate to improper payments, contingencies, potential liabilities, such as environmental cleanup costs. All of these things become very key. So you look at this in a qualitative and a quantitative way. Now, related to emerging risk is long tail risk, which moves us to our second learning objective. Edmund, we hear the term long tail risk, but in application, what does it really mean? And how can ERM help us identify and address these risks? Edmund?
So thank you, Jeff. So long tail risk refers to risks with a very low likelihood, but with potentially devastating impacts or consequences. And so examples would be things like the recent financial crisis or the so-called 100-year flood. With respect to the flood example, these days a 100-year flood seems to be occurring every year as opposed to every 100 years. And so with the advent of climate change, what we're seeing is a convergence between both an emerging risk as well as a long tail risk. So how does ERM help to address long tail risks? Well, one of the ways is the fact that ERM forces us to take a much more rigorous approach to identifying the likelihood and impact of risk, and to document that process in a much more thoughtful way. But with long tail risk, we can't stop at the point of just looking at likelihood and impact. We also have to look at how the risks are changing over time. And so once you've identified a long tail risk, you need to consider on a go-forward basis, how is that risk changing? Is it increasing? Is it decreasing, or is it stable? Because the approach or the response that you would put in place to a long tail risk that is increasing would be very different from the response that you would put in place for a long tail risk that might be stable or decreasing. And so those are some of the ways that ERM can actually help us to understand and ensure that we have an appropriate response in place to a long tail risk event that might have been identified.
Let's just shift a bit here to the financial crisis. Mm-hmm. You mentioned that was one of the areas that really had the attributes of long tail risk. There were certainly environmental changes that took place over many years that moved us in that direction. There were certainly some that raised the aura that this was a problem, but overall, people really missed the emergence of this risk until it was really, I would say, too late. Can you kind of talk a little bit about how that played out as a long-tail risk?
Sure. Yeah. And so one of the reasons the mortgage crisis emerged is because mortgages over time had traditionally been thought of as fairly low risk, low default rates over time, and as a result, people tended to think about the mortgage industry as being a very safe bet from an investment standpoint. But something happened in the environment that changed the nature of the business, and as a result, changed the nature of the risk that was being taken on. And that is that the mortgages went from being an originate to hold to an originate to sell kind of a model. And what did that do? What that did is that the risks in mortgages on the origination side, those risks were being pushed off into the marketplace. And so as a banker in the past, what I would do is if I knew I was going to be holding a mortgage for 30 years, I would make sure that mortgage is going to be repaid. In the originate to sell model, I would originate the mortgage and I wouldn't be concerned about whether or not the mortgage would be repaid, because I know I'm not going to be holding that mortgage for the 30-year term. And so as a result, something changed. And this goes back to what we said earlier about maintaining situational awareness. The environment changed. And so as a result, the nature of the risk changed. And as a result of that, you took a very simple instrument like a mortgage and made it much more risky by the way in which those mortgages were being originated and pushed out into the financial markets. And so as a result, you started out with what might have appeared to be a long tail risk, and then all of a sudden, because of the way the business was being processed, those risks actually turned into something much more devastating, and that's what we ended up seeing ultimately in the financial crisis.
Did the insurance component of that have any bearing on it?
Well, it did. It did in the sense that the so-called insurance, the credit default swaps, was a way for organizations, again, to move the risk off of their balance sheets onto the balance sheet of another entity. And it just so happened that the entities that were assuming that risk, like an AIG, didn't treat those instruments, the insurance, the credit default swaps, as true insurance instruments, or as an insurance policy should have been treated, in the sense of setting aside an appropriate reserve for potential losses based upon the risk that was being taken on. And so again, the nature and character of the overall industry changed, but the processes and the risk assessment methodologies that were used didn't change to match what was actually occurring in terms of how this business was being done. And in the end, that is what ultimately gave rise to the financial crisis. The problem wasn't so much that that risky mortgages were being issued. The problem was that the risk inherent in those mortgages was not being properly priced in the marketplace, wasn't properly understood and assessed, and as a result, there was an insufficient amount of reserves and capital set aside to support the risk that, in the end, was actually taken on through the issuance of those instruments.
Yeah. This is just a tremendous example of what long-tail risk is. It is very deep and very wide. It's got many owners. If one were to look at the folks that actually bought homes, they were banking on prices continuing to go up at unsustainable rates. They were over-leveraged. So when that perfect storm hit, it had devastating effects. And ERM is really about looking for those indicators looking for those things both internal to your organization, but also part of the environment that you're working in, part of your everyday life. Shifting now to our third learning objective, strategies to gauge effectiveness of risk mitigation. First and foremost, I can't emphasize this enough, it is imperative to understand the root cause or root causes of the risk. Risk mitigation can take many forms, but at the heart is targeting actions to address root causes of risks. You do not want to only treat symptoms of the problem. The root cause may be multifaceted. Don't just stop looking when you find a cause. It may transcend multiple organizations or multiple agencies or multiple levels of government. You may need to look outside your own organizational borders. It may require legislative change or a recognition that policy requires actions to mitigate a built-in control limitation. An example is the Earned Income Tax Credit, where the IRS is required by law to make payment based on a filed tax return and must essentially determine eligibility after the fact. There's a large dollar value associated with the improper payments from this program, and while certainly not all, many can relate to fraud. In thinking about mitigation, it may require citizen engagement, such as fraud hotlines or public awareness campaigns. It may represent business transformation, including cultural change management. Cultural change is never easy, always tough, and can take time to become fully embedded in the organization's culture. Harvard University talks about cultural transformation in terms of a 7-year journey, but it becomes even more difficult, really, when you've got organizations that are large, stovepiped, hierarchical, and set in doing things certain ways. Mitigation may be needed because of the result of layering process upon process and control upon control, often in a siloed and segmented manner, without regard to the cumulative impact and the cost of control. Do you have, again, too many controls, but not the right ones? Do you have so many things on your plate that you don't really place proper focus on any one thing? And it may be more than one or all of the above. They can all be drivers, they can all be reasons. For example, after spending over a decade and over $1 billion developing a new travel management system, in 2010, the Department of Defense testified that more than 70 types of travel in over 2,000 pages, yes, 2,000 pages, of sometimes contradictory rules and regulations made this new system unworkable. To address the root cause, the Department of Defense announced plans to replace existing requirements with travel policies that are simple to understand, easy to administer, flexible in responding to changes in the travel environment, cost efficient, and allow for industry travel capabilities to be leveraged. The root cause is that there was far too much control, too much variation and complexity, and far too many processes and procedures over an area where the risk of loss to the government is known to be extremely low, and the impact is virtually non-existent in comparison to the performance of the Department of Defense's critical programs and mission to defend our nation and protect our national security. The system being replaced was so onerous that the new system simply fell of its own weight, in large part because existing practices were not first redesigned and streamlined. So it's very, very key to focus on root causes. It's very, very key to ensure that before you embark on something that's large and potentially unwieldy, that you step back and say, what am I trying to achieve here? What are my basic enterprise risks? And how am I addressing those risks in an effective and efficient manner? It is important to always guard against making too quick a judgment as to root cause. Also assure you are not only fixing the right problem, but you are not introducing new problems. In the end, for example, with Defense's system, they found that it actually introduced new problems because people had trouble actually booking trips to the right city. Next, working in partnership across organizations and management disciplines to break down silos can be a critical component in establishing the root cause or causes of the problem. In this way, risk mitigation can be properly targeted. It's all too easy to just say, I'm going to focus on what I can control, and if it goes wrong at another level, it's not my problem. Once I've dispersed the money, let's say, what happens on the other end really doesn't matter to me. Well, if they are your program funds, and that program ends up mired in failure or fraud, waste, and abuse, in essence, you own it, or you own maybe the lion's share of whatever that set of issues are. After clearly defining parameters of the risk and its root cause, remediation plans should detail strategic and tactical actions to remediate the risk to an acceptable level in line with the organization's risk appetite. Again, you're always tying back to what you have established as your appetite for risk. How much are you willing to assume here? You don't want to over or under control, and you want to always be aware of both emerging risks as well as those things that can have a long tail. Strategic actions would include top management ownership of remediation. They have to own it. So the importance is clear across the organization and a sense of urgency is instilled. A clear statement communicating the nature and potential impact of the risk and its root cause. Communication, and even more communication is a hallmark of leading organizations. Engagement with stakeholders at the outset to gain buy-in, including external parties such as the Congress. Be open and transparent about problems and engage decision makers in developing solutions, especially if public policy changes are proposed. You have to have champions across the organization, since enterprise risks generally extend beyond one or two entities. It could be 4 or 5. In the end, you want everyone to understand the situation and to own the solutions. You have to step outside of your comfort zone to move beyond the status quo. It's not just about doing things the way you've always done them before and hope for the best. Everything must be on the table. As Albert Einstein said, we can't solve problems by using the same kind of thinking we used when we created them. Tactical steps for accomplishing the strategy could include benchmarking, adoption of leading practices, and acknowledging there might be practices that are used by others that could apply to you. There's oftentimes in organizations perhaps too much of a feeling that everything has to be tailored to our particular way of doing things. So look for leading practices. Move to shared services or outsourcing for those things that are not as critical to your everyday mission. You might have to embark on organizational realignment. And in most areas where it is an enterprise risk, you have to have interim mitigation actions, especially where longer-term solutions will be necessary to address the root cause. Now, I want to pause on that a minute. There is many times a sense we have to come up with a grand solution or a grand design, embark on a major new system, and these things can take years and years and years and years and have a very rocky path. And oftentimes by the time they're up and running, the environment's changed. We're on to other things. So you have to have these interim steps. Former Secretary of the Treasury, Paul O'Neill, oftentimes said the goal should be to correct your problems or at least mitigate them to an acceptable level in no more than 6 months. So when you have these large efforts, when you haven't always determined the root cause, and when there's not really a clear buy-in to change the status quo, you can continue to have those same risks over and over again. I mentioned before the high-risk program at GAO. Because of the nature of many enterprise risks that might be with us for several years before they're fully resolved, continual monitoring of the situation to gauge where mitigation stands and to guard against the introduction of new risks or a change in the profile of risks becomes very important. We must ensure also that we have needed and available resources and the rationale for any investments. We have to focus on expected completion dates, and for longer-term solutions, interim dates, by which actions that partially mitigate the risk will be completed. While remediation may be a continuous process, in areas such as IT or cyber risks, which probably never end, they're always morphing to something new and different. Given the constant state of change and the advancement in technology, this does not mean there will be a grand solution a decade from now. I mentioned before, these things cannot drag out for long periods of time, or that itself alone is an enterprise risk. The inability to come to conclusion, the inability to act, the inability to move beyond, let's say, a rigid stovepipe can be an enterprise risk. Something like the fact that today we're having a lot of very seasoned staff who have dedicated a career to government. They're leaving in large numbers. That can present an enterprise risk, and it's not something that we can study or work on for a decade. We have to act quickly on it. To reiterate, risk mitigation encompasses shorter-term actions to lower the risk to a more acceptable level, in line with the organization's risk appetite, even if an enterprise-level risk still exists. Edmund will now share with us the application of risk mitigation concepts. Edmund?
Thank you, Jeff. So when we speak about risk mitigation, it should be understood that mitigation encompasses a full range of potential responses to an identified risk. And so what I like to tell my clients is that that range of responses basically falls into 5 categories. Control, assume, transfer, avoidance, and in the private sector, even increasing a risk might be a potential response. And so let's talk about control for a moment. So typically when we speak about risk, the other side of it is a control, which encompasses the policies and procedures that an organization might implement in order to reduce a risk to an acceptable level. And that's typically the conventional wisdom that people have when we talk about risk. What can happen there, though, and I think you mentioned this earlier, is that sometimes a control can become a knee-jerk reaction or a knee-jerk response to a particular identified risk. And over time, you could have a situation where an organization finds itself in an over-controlled situation as it relates to a particular risk. And sometimes that can be just as bad as not having it controlled at all. Because again, it's about a risk-return balance as well. The other potential response is to assume or accept the risk. And so, I like to call this the do-nothing response. But it should be understood that 2 things. 1, doing nothing is a response. Doing nothing is a choice. But the difference between doing nothing in an enterprise risk management environment or in an enterprise risk management context versus defaulting into a do nothing scenario is that the choice to do nothing is an informed choice. It's a choice that's made based upon information, based upon understanding the nature of the risk and understanding the potential impact and making a conscious choice to take on that risk without implementing any specific action in response. Another potential response is a transfer. And the easiest example there is insurance. All insurance is a form of risk transfer. And so what you're doing is you're paying a premium, and in exchange for paying that premium, you are effectively transferring the potential impact of that risk to the balance sheet of the insurance company. Another example of a transfer might be something like an outsourcing. Here again, it's an operational risk. You're transferring the risk, the operational risk exposure from your organization to an outside entity. Now the key thing about risk transfer, though, is that transferring the risk to another entity does not relieve the organization transferring that risk of responsibility for understanding what the risk is and ensuring that the outsourced entity can effectively absorb and handle that risk on behalf of the organization that's doing the outsourcing. And so it doesn't do any good, for example, to buy an insurance policy from an insolvent insurance company because you've paid a premium, and then when the time comes to file a claim, there's nothing there. Similarly with outsourcing, if an organization that you're transferring the risk to through an outsourcing arrangement has poor risk controls, then in effect you've compounded your exposure because you still have responsibility for the risk. You've paid the outsourced entity to take on the outsourced responsibility, but you still are facing the problems in the event that there's a breakdown at that entity that you've transferred, that you've outsourced those services to. And so with transfer, and I'm spending time on this because it's really important, with transfer, basically what happens is it changes the nature of the surveillance of the risk. So not only do you need to maintain surveillance over the original risk itself, but you also have to maintain surveillance of the entity that you're transferring the risk to. So here again, if it's an insurance company, you now have counterparty exposure. So you want to make sure that over time, you're monitoring to make sure that the insurance company is solvent. So you're not paying premiums into an insolvent entity, or that you're not transferring through an outsourcing arrangement the the processes and the services to an outsourced entity that, again, can't mitigate the risk exposure that you were seeking to offload. Another response, if you will, to risk and mitigation is avoidance. And here again, avoidance is kind of similar to accepting the risk, but again, it's looking at the nature of the program or the challenge that an organization might be looking to undertake, and making a conscious choice to, well, no, we're not going to put our people into a situation that that might result in harm to them, for example. And so an avoidance strategy might be something like the State Department choosing to to close an embassy or close a consulate office because the safety of a particular environment in a country has become untenable. And so those are some examples of, again, mitigation strategies or responses that an organization can undertake, and ways to sort of think about those mitigation strategies in the context of the mission and the program objectives that an organization might be seeking to implement.
What's very important here is that the entity have a very clear notion of what it's trying to achieve, what risk it's willing to accept. In your everyday life, you make these choices. I've elected, for example, not to try any skydiving. I see the risk benefit as not being very high to me, but others don't quite see it in that manner. But you want to think about the enterprise. It all anchors back to what your mission is, what your risk appetite is against your profile, what you're trying to achieve, what you're trying to really avoid. And do it always being extremely mindful of the fact that it's not something that just is cast in stone. It's very fluid, it changes all the time. And there have to be decisions at the top leadership levels. There have to be an understanding at those levels. There has to be an articulation or a communication at those levels so that people understand and they know how far they can go, what is most important, and they're always a student of the environment around them as well as a student of the world. As we leave you today, a few final thoughts. Make full use of ERM to effectively and efficiently focus on the highest areas of risk, those areas of the most importance to the mission of your organization. Accept that the current fiscal situation demands bold action to reduce costs while still delivering optimal public services and achieving important missions. View today's budget challenges as an opportunity to strengthen and streamline processes and procedures while balancing risks and rewards, costs and benefits. Play an important role in providing needed leadership and technical assistance across your agency. Take up the ERM banner. Use its full potential to better manage risks while enhancing mission and program delivery and while reducing cost. On behalf of a firm and KPMG, Edmund and I thank you so much for joining us today. We hope we have achieved the objectives of this training session so that you now have a better understanding of strategies to identify and respond to emerging risks, to understand and address long-tail risk, and to gauge the effectiveness of risk mitigation so that remediation addresses root causes and adds value. If you have any questions or would like to know more about any of the topics we covered today, here is our contact information. Thank you. Have a great day.